this is going to be a big, big, big thing for everyone.
Everyone seems to be up in arms about it.
And even if it's first 250,000 is okay, still in the old.
And the government, the Prime Minister and the Minister of Finance are saying,
I'll be bringing each week a different guest with all the answers that you have the questions for. And this way you can come back to my podcast for any questions that come to your mind, and you can focus just on working, as everything else this podcast will provide you. Hi, welcome to the Simple Wealth Wisdom Podcast. I'm your host, Gakhar. My work helping successful business owners and professionals like you build and maintain your lifestyle and legacy exposes me to many very interesting specialists in tax, accounting, law, estates, and investments. In this podcast, I share those people with you and your team so you can hear directly from them. So, if you're a successful business owner or self-employed professional, stay tuned for a lot of business building value. Today, I'm very excited to have Stuart Dollar as my guest. Welcome, Stuart.
Thank you very much, Sim. Pleasure to be here.
Thank you so much. Stuart is a lawyer and a director for retail insurance tax solutions with Sun Life Financial. He has over 20 years of experience with advanced life insurance planning and strategies in Canada and in US. Wow, we've got a lot of clients who want to know about US as well. He's an expert on life insurance, critical illness, and long-term care insurance taxation solutions. And I'm very excited once again to have him on this podcast, where once again, my business owner and self-employed professional clients can have a lot of their questions regarding tax solutions be answered. So once again, welcome, Stuart. And to begin with, this is the time everybody is talking about new budget. So I want to start with that. Let's begin with something that everyone is talking about, the capital gains tax inclusion rules.
Yeah. Well, as probably everyone knows, the capital gains inclusion rate was increased from 50%, where it's been for quite some time, to 2/3.
Yes.
But it applies differently. So for corporations, it applies on the first dollar of a capital gain.
Right.
For individuals, 50% on the first 250,000, and then 2/3 after that.
Right.
Everyone seems to be up in arms about it. And the government, the Prime Minister and the Minister of Finance are saying it's not really going to affect many people. It only affects that 0.013%.
The wealthier ones, that's what they think.
That's what they say.
That's what they think.
I don't think that's entirely accurate, nor is it how many people feel about it. You and I have both heard the parliamentary budget chief talk about how the numbers support what the government says. I think, though, that's when you think of people who rely on capital gains for income to support their lifestyle, much the same way many Canadians rely on employment income or commission income, dividends, wages, and so forth to support their day-to-day lives. And that accounts for that vanishingly small number the federal government's talking about. I think what a lot of other people are thinking, though, is that this increase in the inclusion rate is more like a tax on wealth.
Yeah.
Because a lot of business owners, you probably experienced this, view the value of their business as a nest egg that they've built for their entire career.
Yeah.
At some point, they're going to sell it on, and then they're going to use this nest egg to support themselves and their spouse in retirement.
Yeah.
And now this comes along and is an additional tax on that nest egg.
Yeah.
And it decreases the amount of wealth they have for retirement. And so I think that accounts for why so many more people than that 0.013%
are affected.
Are affected.
Unaffected, yeah.
So and it's the same for people who have got a cottage that they want to pass on, or they have an investment portfolio, non-registered investment portfolio they want to pass down.
It goes all the way to whenever they acquired it?
Whenever they acquired the cottage. Now the investment portfolio, I can speak from a bit of experience. My parents had an investment portfolio that they never touched. They didn't sell any assets. They didn't buy any assets. They just lived on the dividends. And so a lot of capital gain in that portfolio. And so people like that are going to be experiencing a much bigger tax hit when they pass away, and there's a deemed disposition of that portfolio, deemed disposition of the cottage. And also it could be if the individual dies prematurely owning a business.
And then
disposition
there
of the
was no
shares.
time. Yeah. This is upsetting to a lot of people, actually.
It is. And I think part of the reason it's upsetting is because government is being a bit disingenuous, if I can use that term, in describing the impact of this tax on people.
Yeah.
Because a lot of other people don't feel it the way the government is describing it.
Right.
They feel this nest egg that they've been building up, that they've been crafting, creating, working so hard for, and now some more of it is going to be taken away.
Yeah. And people who have had these cottages for years, and they were just thinking, okay, you know what, this is another property that we have, and in case they need to sell it, this is going to be a big, big, big thing for everyone. Even if it's first 250,000 is okay, still in the old 50%, but still more than that is going to be affected.
It's still the interesting thing is that it's raising it's raising people's knowledge or awareness of the capital gains tax, because the 50% rate has been with us for a long time now. Admittedly, in the 80s it went up to 80s or 90s, it went up to 2/3 and then went up as high as 3/4.
Yeah, 3/4. That's what I remember that.
Before going down in, I think, in the 2000s, all in 1 year.
Yeah.
It also tells me that if you look back to that time when the inclusion rate went up, it was a time when the government was in bad need of money. At that time, the national debt was such that I recall about 30 cents of every dollar the government took in revenue was paying interest on the accumulated debt. Today they're using different metrics to describe how bad it is. I mean, pick your metric and apply it. But nevertheless, it strikes me as an indication of a government that is desperately in need of funds.
Yeah, that is right. That is right. Absolutely. And now you and me both are into the insurance field. And we're talking about always insurance, and my clients, my viewers are all business owners and professionals, as I always say that. So having them a corporately owned insurance policy, I would like you to just share a little bit of light on that, do the proposed changes to the capital gains inclusion rules, they affect corporately owned life insurance?
Not particularly, because the corporately owned insurance policy, like any insurance policy, is not a capital asset. So if it goes through its full life cycle to the death of the life insured person, it's not meant to be disposed of, but it can be. But it's not a capital asset when it's disposed of. And when it does end with the death of the life insured person, it pays a tax-free death benefit.
To the capital dividend account as well?
Well, to the corporation.
And then through that they can go to the family,
And then what the corporation does is it credits its capital dividend account with the death benefit minus the adjusted cost basis in the policy. And adjusted cost basis is essentially it's the money, it equals the premiums which were paid for with after-tax money, minus something called the net cost of pure insurance. In some cases, if the life insured person lives long enough, the adjusted cost basis can be zero.
Equal to,
And then the great thing about the capital dividend account is that a capital dividend is paid tax-free to the surviving shareholders. That could be the estate.
That could be the estate.
Which would then distribute the money to the heirs of the deceased business owner.
Very rightly said. So, Stuart, what do you think? Why should somebody even own an insurance policy, a corporately owned insurance policy? Why should they not actually take out the money and invest it into something else? Why should they actually do that?
The fundamental reason is that life insurance is there to protect the policy owner from the consequences of a person's premature death.
Right.
You never know when someone is going to die. Most of these strategies that depend on saving money, taking money, building up a sinking fund, for example, assume that a person is going to live a certain amount of time.
Right.
And I'll be the first to admit that if you live into your 90s, then that investment strategy could very well beat the death benefit. However, say you're my father, 5 years old, his father dropped dead at Union Station, 43 years old. No one was expecting that to happen. So, and many people have many other examples. To talk about it in the corporate insurance field, you can think of a corporation's life cycle. Once a business gets beyond the mere survival stage and becomes a going concern, then there are key people in that business that you would
Very
think
important, yeah.
they're very important. If they died, then this business could be very severely affected.
Yeah.
Think about how the creditors might feel. Think of how the bank might feel, how the how employees might feel,
Yeah.
how customers might feel.
Because they are the key people for the business, right?
And they're the people that the business owner would think that if I take a vacation, this is the person I leave in charge.
Yeah.
So that's one thing. If this person were to die prematurely, then the business could suffer. Its continuity would be affected quite severely. So you need to think about insurance on that person. Moving a bit beyond that, you start thinking about succession planning. I've got this successful business and I want to make sure that if I leave it at some point, I can extract the money from it.
Yeah.
It's not exactly a liquid asset,
Yeah.
but it does have considerable value.
So we're talking about retirement here, or are we talking about
a buy-sell
sale, or
like a sale.
like a sale? Okay.
Yeah, so we're talking about a sale of the business.
Yeah.
Sale could happen at death.
Yeah.
In which case, you've got to have the money right there, so that you
To
can
take care of
the obligations that people have got to buy your share of the business.
So do you think that my business owner clients who are incorporated professionals or all of those can consider their business life insurance policy in the corporation as another asset, just like they've got other investments?
Of course.
That can be liquid as well, if needed, right?
Yes, well, there always has to be a need for insurance to protect the business against the life insured person's premature
Very good
death.
point. Everyone should know that the difference is there has to be a need for insurance.
But once there's a need for insurance, the business has a choice as to what type of policy it's going to use to protect. It could use a term insurance policy. Term insurance policies have a fixed term during which they're in force, beyond which either the policy has to be renewed at higher premiums. It can be converted into permanent life insurance, typically with a cash value, or past a certain point you can't renew a life insurance policy.
Right.
But the other alternative is a cash value policy. And there you can pay premiums, some of which will accumulate in the cash value.
Right.
Under our laws, the growth in the cash value is tax deferred, tax-free if the policy ends with the life insured person's death. You can, with some policies, put more into the cash value than what's strictly speaking required to pay the premiums, pay the cost of insurance charges. For
additional deposit options plus premiums.
And then policies are invested. The cash value is there for the policy owner, corporation, to access, but is also invested by the insurance company to support the obligations the insurance company has to pay a death benefit, for example.
Right.
That is a valuable asset, because if you look at the investments that the insurance company has that money in, typically they're long-term investments. They are conservative, but the rates of return are oftentimes not that far behind what you might find with riskier investments that you would buy on your own. And so if you looked at the entire portfolio, and here we're talking about a corporation where the business has been quite successful and the corporation is just retaining earnings.
Right.
It's creating more money than the business owner needs to support for their day-to-day needs.
Right.
It's a nice place to be.
Yeah, everyone wants to be there. But again, a planning is needed at this stage.
Planning is needed because you've got money that's piling up in that corporation.
Yeah.
If you leave it there and invest it, it's not money that's...
T5.
It's
tax.
It's taxed at a high rate.
Yeah.
It doesn't get the small business tax rate because it's just investment money.
Yeah.
That's about 50%.
50.17%. You're paying tax on passive investment. Absolutely.
Depends on the province or territory you're living in, but yeah, about 50%. Additionally, if you were to die or if you want it to come out, taxed as a dividend.
Yeah.
Now there's a mechanism called refundable dividend tax on hand that helps ease the double taxation that results from that. But nevertheless, it's taxed again in your hands. And then if you want to invest it in your hands, the returns are taxed again.
Yeah.
In addition to capital gain building up.
Yeah.
So a lot of tax. Sometimes I wish tax had 4 letters in it, because then I could describe it as a 4-letter word, but I can't. A life insurance policy can be a good thing to have in a corporation, because the money that's inside that policy can be treated similarly to an asset that is like all your other portfolio assets. Can mesh with those assets as part of your entire portfolio and be considered as a asset that has certain attributes and characteristics alongside some of your others. So if you think of that asset in the insurance policy as, say, more conservative, you might be able to take greater risks with other non-insurance policy assets owned by the corporation, or owned by you personally. So we don't think of life insurance as an investment. It's not. It's protection.
It's protection.
But the cash value in a life insurance policy is one of the assets that you as a business owner own through your corporation, and that should be treated as part of your portfolio.
Net worth, yeah. So this is basically what I understand from this conversation is that it's diversification of the portfolio. You're not saying don't invest there, don't do that, but this should also be a part of it.
Correct.
Right. So that brings me another question that a lot of time people think that, okay, I have a cash value in the policy. I can take it out. If there need be, they can take it out at any time. Does that affect the policy?
Yes. You can take the money out. There's different ways of doing it.
Yes.
One way, for example, is you can take out a policy loan.
Right.
And a policy loan is treated as tax-free up to the adjusted cost basis.
Yeah.
And then it's taxable after that. Any amount you repay is treated as deductible until you've used up all of the previously taxable amount. So that's one way. You pay interest on the loan.
Yeah.
And the right to take a policy loan and the interest that you pay is determined by the language in your policy, the contract language.
And sorry to interrupt you, but the policy loan is contractually guaranteed. They cannot say no.
Correct.
There's no financial underwriting needed.
That's right.
Which is a very good part.
You could be emerging from your 7th bankruptcy.
Yeah, and you still get it.
You still get it.
Yeah. So that's a good way to keep it, it's a good creditor proofing as well, I would say that.
Yes.
Is it?
Well, the policy is owned by the corporation. So from the business owner's perspective, that person's personal assets are not subject to, or that person's personal assets are subject to seizure.
Okay.
But whatever is in their corporation, it's not. And the trouble, though, is with a corporate-owned policy, you don't get the same creditor protection. One way you can get some creditor protection against the business's creditors is if that structure is holding company, operating company.
Yes, that's the next question we're coming to.
Yeah, so for example, if you own a policy personally and you haven't set up, and you've only named the estate as beneficiary, then that policy is exposed to your personal creditors. If you put it into your corporation, it's not exposed to your personal creditors. It is exposed to your corporation's creditors, which could be the trade creditors. It could be CRA, for example. If, on the other hand, it goes into the holding company, then it's protected from the operating company's creditors.
Yeah.
So you get that level of creditor protection.
That's good. That's something I always suggest my clients do. And I think this is a very good, this is a very good question. Very good, actually, something for everyone to understand that positioning of the policy is very important, where you're positioning it. So that's a great thing that you talked about holding company. And I think now I would like you to talk a little bit about if somebody has bought the policy in their operating company, something like transfer of life insurance policies between the corporations and shareholders, or between corporations, holdco to opco to holdco. What do you say about that?
You have to expect that there's going to be potentially some tax to pay.
Okay.
So the first thing you need to do is discuss the proposed transaction with your tax advisor, typically your accountant, to get a feel for just what you can expect. The other thing is you may have to have an actuary involved to provide you with an assessment of what that policy's fair market value is. Its value could be its cash surrender value, but depending on the age, health of the insured, it could be more than that. It will never be more than the death benefit that the policy pays. So let's assume that we're talking about a company that owns an insurance policy, and now the business owner is setting up a holding company, and you want to transfer ownership of that policy from the operating company to the holding company.
Yeah.
So that is going to be a disposition, we call it, to the operating company. It's as if it was sold, even though it wasn't. So the disposition is taxed to the extent that the value of that policy, and that's a term of art, exceeds the policy's adjusted cost basis. Value is the greatest of three items. It's either whatever the new recipient of that policy pays you for it.
Okay.
It's the cash surrender value, or it's the adjusted cost basis, the greatest of those three amounts.
Okay.
So take that greatest of amount,
Yeah.
subtract adjusted cost basis from it, you have the taxable amount that the operating company has to take into income.
In the income, okay.
One way of doing this is by way of an intercorporate dividend. So you declare that policy is going to be transferred up to the shareholder, which is the holding company now,
Right.
as a dividend. And instead of that dividend being paid in cash, it's going to be paid as the policy. And that's why you have an actuary tell you what the fair market value of that policy is. You also have to make sure that the operating company has enough safe income, they call it, retained earnings, to cover the value of that dividend. Once you've got that, then the holding company has to take the value of that policy into income, but then it should be able to deduct that so that the transfer becomes a tax-free intercorporate dividend. And this is another reason for why the accountant has to be involved, so that we know before we do this transaction that it will be tax-free. The operating company, we look at those three items we talked before.
Yeah.
Whatever it received for that policy, nothing, because you don't get paid for a dividend.
Yeah.
And then it becomes the greater of cash surrender value or adjusted cost basis. So a potentially much smaller taxable amount for the operating company. And now that policy is in the holding company. The final element to it is how the holding company determines its adjusted cost basis in that policy. And that will be the value that the operating company had to use to determine its tax position.
Okay.
So it could have been cash surrender value. That will become the adjusted cost basis for the holding company. That's important because if the insured person dies, the death benefit minus adjusted cost basis is all you can put into the capital dividend account.
Right. So, any suggestion for my viewers at when should they consider positioning the policy? Is it because situations change? Somebody bought the policy in OPCO, they don't even have a holding company right now. Do you think it's a great idea that the moment they start the business, they should have a holdco set up as well if they're planning to have a policy there? And holdco, and can the policy be the only asset in the holdco at that time?
I would suggest that you not allow the tax tail to wag the business dog.
Yeah, good one.
That's my first thing.
Yeah.
That having a holding company, having a corporation is complicated.
Yeah.
To begin with, having a holding company, operating company is even more complicated.
More complicated, yeah.
So that complexity requires the interaction of the business owner with professionals, lawyers, accountants, and there are fees.
Yeah.
Every year there are fees. There are also obligations. You have to have annual meetings. You have to have corporate resolutions to do things.
Yeah.
So you've got to make sure that you're willing to take on that extra complexity. When a business is first starting, I wouldn't even suggest a corporation.
Yeah, that's right.
Once it gets to a certain spot where its day-to-day survival is not in question any longer, then business owner may consider incorporating, and then only later consider a holding company. This is a separate issue, though, from life insurance.
Right.
Life insurance should be in place when you have a need for it. Whether you're a sole proprietor and you've got a key person, you should have insurance.
Right from the beginning.
From the beginning. Now, if there's a cost someday to transferring that policy into the corporation, or maybe even transferring it from that corporation years later to a holding company, so be it. Yes, that's a cost. The worst cost is having a key person die without there being
with no insurance, yes.
So even though my life is tax, I have to step back all the time and recognize the more important thing is having the insurance in place. Because I do talk with people,
Yeah.
advisors, and they say, well, yeah, there's going to be a cost to doing this. And I say, well, yeah, there will be, but step back a minute. What's the real issue? It's getting that insurance in place. That's the more
Right.
important thing.
That's the more. And, coming from somebody who's a lawyer who knows the insides about how the corporation should be structured and how it can affect them, I think it's a great insight. We have run out of the time. I see the timer ring, but there's so much I want to ask you more. I'm kind of getting into it more and more right now, and I have so many questions going on in my head right now, Stuart. So I think I have to run a part 2 as well, maybe sometime later, but it has to go. And but it was very, very nice the way you helped everyone on the structuring side, positioning side, tax implication side. So I'm sure everyone is going to enjoy that. Thank you so much for
My
everything. Thank you, Stuart. And this has been very informative, as I always say that. And I'm sure everyone would ask me a lot of questions and they would want you to come back. So with more questions, I'm going to see you again in my office. Thank you once again.
Thank you.
And that was another episode of the Simple Wealth Wisdom Podcast. Please let us know in the comments what you like the most about this podcast. And if there's anything else you want to see or ask, I'll make sure to bring that to you in our future podcasts. Watch for us again. Until next time, stay safe. I'm Gakhar. Thank you.